Please welcome Chief Executive Officer, Brookfield Renewable Partners, Connor Teskey.
Good afternoon. My name's Connor Teskey. I'm the CEO of Brookfield Renewable Partners. Thank you for being here, and thank you for your interest in our business. Today, we're going to provide an overview of our platform, but in particular, our business model, which we feel in the last 12 months has been firing on all cylinders, not only driving success in the past, but positioning us for future growth. Then, Hannah will explain how we are able to enhance the value of renewables businesses when we can acquire them and integrate them into our global network. Next, Ignacio will speak about our approach to capital deployment, and in particular, how we can source attractive value entry points for new investments across market cycles, as well as opportunistically recycle capital into accretive growth. And lastly, Wyatt will speak to our financial position as well as the outlook for our business. The last 12 months have been the best in the history of Brookfield Renewable. And yes, we've had very significant market tailwinds, but there's a few dynamics unique to our business that we feel have driven that performance. We've positioned ourselves to capture the growing demand for clean energy from corporates, particularly tech companies. In the last few years, we've invested a significant amount of capital at very attractive value entry points, even when markets were a bit uncertain. And today, those investment decisions are aging very well. We've significantly enhanced our capital recycling activities, solidifying the final component of our value creation and self-funding business model. And equally important to everything we have done is what we haven't done. We've never compromised on our investment discipline, and we've avoided the segments of the renewables markets that are seeing headwinds or write-downs today. And this is showing up in our performance. We've delivered another record year of financials. In the same year, we've set record amounts of deployment into growth, as well as raising record proceeds from asset sales at very attractive returns. And we've done all of this while maintaining the strength of our balance sheet that continues to have one of the highest credit ratings in the sector. And this has allowed us to continue a financial trajectory of delivering double-digit FFO per unit growth, a trajectory we've been on for more than a decade. And it's that earnings growth that supports our dividend. We raise our dividend every year, and over a long period of time, we've consistently delivered dividend increases within our 5 to 9% annual increase target range, a target we remain committed to today. And our ability to continue to deliver that financial growth is more secure today than ever before. This year, we will bring online, through COD into cash generation state, 7 gigawatts of new renewable power capacity. That's up from 5 gigawatts last year. It's a number that's going to grow to north of 8 gigawatts next year. And these high-returning development dollars ensure that each year we are bringing online an incremental $70 million worth of FFO to BEP purely from organic growth initiatives. That doesn't even begin to talk about our growth through M&A, where in the last 3 years, we've averaged just shy of $10 billion annually of deployment into growth via inorganic means. And while that scale is exciting, what's most exciting to us is our ability to continue to secure attractive value entry points on those investments, even as our business has scaled. And what this means is we have delivered 4 years of unprecedented growth and value creation within our business as we've captured the market tailwinds and the increasing demand for our product. We expect this growth to not only continue, but to accelerate going forward as those tailwinds remain robust and we have an increasingly larger platform and leadership position to continue to grow from. Today, We have an unmatched global renewables platform with a leading market position in every major power market around the world and every major clean energy technology. We can service our clients in ways that few can, and given the scale of our business, we can recycle individual assets or platforms without ever compromising our global capabilities. Our scale allows us to pursue the largest and most attractive opportunities whenever, wherever they arise, and we can pursue growth either through organic development or through M&A, whichever is most attractive. And while the vast majority of our business continues to be focused on renewables, we have made select investments in other decarbonization technologies that will be future growth avenues for our business. And while it's exciting to talk about that level of growth, we feel the thing that has defined our business for the last 12 months is the strategy and discipline around which we have executed. Today, we are increasingly the partner of choice within the renewable power space. That's not just as a corporate contracting counterparty or as an investment partner in a JV, but increasingly that's as a counterparty when we look to sell assets. Platforms sold out of Brookfield Renewable are viewed as high quality. They'll perform for the next buyer, and we're seeing that in the valuations we receive. We've consciously positioned ourselves to capture a disproportionate amount of growth of the growing demand for clean energy from the tech companies, while at the same time we've strategically expanded into new renewable power classes that are growing very quickly and will be critical to the future of global electricity grids like nuclear, batteries, and biofuels. And again, we will highlight this point. Equally important to what we have done is what we haven't done. We've never compromised our balance sheet, and we've never compromised our investment discipline. We've avoided investments that required taking uncontrollable development risk, and we've never invested in things if the risk-adjusted returns didn't make sense, even if they were viewed as high growth. And where that shows up today is we have zero exposure to the subsegments of renewables that are seeing headwinds and write-downs. Rather, we've chosen to stay patient in these sectors and will look to invest at scale in the highest quality businesses when the value entry points come to a reasonable level. So let's dive into some of these dynamics a bit more specifically. We are better positioned than at any point in our history to meet the increasing clean energy demands for our clients. We have more projects at a greater scale in more geographies across more asset classes than ever before. Put very simply, we can offer more solutions to a greater number of customers. And this is important because the demand just continues to grow. The demand for renewables around the world has been growing consistently due to a number of factors. Renewables are the cheapest form of bulk electricity production in every major market around the world. Decarbonization trends continue to accelerate. Renewables can be part of the solution around energy security, as you don't need to import the sun and you don't need to import the wind. And we're seeing growing demand due to the broader electrification of industrials and transportation and real estate around the world. And all of these dynamics have been multiplied in recent years due to the significant increase in demand for clean power driven by the tech industry. Today, it is the demand from the techs and renewables' low-cost position that are the biggest drivers of growth. And why is that? It's because today, the sourcing of power is the bottleneck on the critical path to growth for the largest and fastest growing companies around the world, the large tech companies. To grow your cloud and AI business, you need more data centers. And in order to get your data centers permitted and built, you need to bring a power solution. And the power solution of choice is renewables because it is the cheapest and it is the cleanest. And while we by no means predicted the AI revolution, our strategy within our business has positioned us well to capture this growth. For years, we've been investing in the highest quality renewable developers and the most advanced pipelines in core markets around the world. This has allowed us to service those large tech companies at a geographic reach and at a scale that few can match. As a result, we've captured more of that business. It's allowed us to grow quickly and invest more into those development capabilities and assets, creating a virtuous cycle and a business position that it is very difficult for others to match. Today, over 90% of our development pipeline is in the 10 largest data center markets around the world. And perhaps even more important than ownership of those assets is our ability to pair those wind and solar projects with batteries and nuclear and hydro to provide clean energy solutions that are unique to our customers. And here, we feel we're only scratching the surface. Across our global book, only about 30% of our contracted output is with corporates and industrials. That's despite approximately 90% or greater of PPAs signed in the last 12 months being direct corporate offtake. We expect that 30% to increase to 50% in the next 5 years. And this is not just forecasting into the future. We're already seeing this within our business, as demonstrated by our ability to execute that global framework agreement with Microsoft, where we'll build 11 gigawatts for them over the next 5 years to support the growth in their AI business. So switching gears for a second, another dynamic of our business model that has really come to light this year is our ability in the same time period to deploy capital at very attractive value entry points, while at the same time monetize assets at great returns, and in doing so, generate premium returns within our platform. Today, around the world, there are tremendous investment opportunities for those that can build out renewable development platforms and those that can allocate capital across geographies, asset classes, and the development spectrum. And given the capital requirements to build renewables around the world, those that can invest at scale continue to find opportunities to invest in high-quality businesses at attractive value entry points. This is emblematic in our transaction to acquire Neoen, one of the leading global renewable power development companies. But it's not just about a single transaction or a single headline. Whether it was Deriva or OnPath or Exelio or a number of other transactions we've executed over the last few years, we continue to find very attractive opportunities to put capital to work where we can drive value with our scale and our operating capabilities. But at the exact same time, there is a very robust bid for high-quality, de-risk, cash-generative renewables assets, in particular those that have a growth angle to them. And the opportunity to capitalize on that dynamic lends itself to those that have the balance sheet and the liquidity to execute successful sales processes, notably waiting until after a business plan has been complete and being patient to wait until there's supportive market conditions. And while we've been talking about this dynamic all year, it's nice to finally back it up with some transactions. In the last week alone, we have signed 3 large deals, the monetization of First Hydro, Saeta Yield, and Shepherd's Flat. Collectively, year to date, we have raised over $2 billion of equity proceeds from asset monetizations. That's almost $1 billion net to BEP. And the investment returns on that capital is almost 25% IRRs, almost double our corporate targets. And given the ongoing additional asset sales processes that we are executing, the bids we are seeing in the market, and the number of assets within our portfolio that will be ready for sale in the short term, we expect to continue to deliver more results like this going forward. And the benefit is not purely monetary. Increasingly, through these transactions, we are executing in partnership with the largest and fastest growing renewables companies around the world. This creates future opportunities for collaboration, business development, and doing additional similar transactions going forward. Which brings us to the last point we wanted to highlight. While we continue to deploy more and more capital to capture this fantastic growth opportunity, we continue to have a unique self-funding model with a number of accretive value levers that don't exist in everyone else's business. It starts with our balance sheet. Today, we have a strong investment-grade credit rating. We focus on long-duration, asset-level, non-recourse fixed-rate debt, and we have almost $4.5 billion of liquidity and no near-term maturities. This ensures that we are well-positioned to capture any new growth opportunities should they arise. But in addition, we have other unique and accretive funding levers within our business. In just the last 2 months, we've signed 2 new long-term corporate PPAs against 2 of our hydro assets in North America. The increased revenues under these new contracts will create a $500 million up-financing opportunity. Similarly, as mentioned, we're dramatically increasing our capital recycling initiatives, selling assets to lower cost of capital buyers that can be reinvested at accretive levels into new growth. The joy of these 2 funding levers is they give us access to large-scale capital at a lower cost than the target returns we expect to make on new deployment. And this can be paired with our ongoing ability to target the largest and most attractive investment opportunities around the world by partnering alongside institutional capital, allowing us to pursue transactions where we see less competition. So given our business model, the tailwinds in our sector, the leadership position we have, and the discipline we continue to execute with, again, as we have done in the past, we are increasing our growth targets going forward, now targeting $8 to $9 billion of equity deployment into growth over the next 5 years. And with that, I will hand it over to Hannah.
Thanks, Connor. My name is Hannah Labuschagne. I'm Senior Vice President here at Brookfield Renewable and Head of Global Procurement. And I'm here to talk to you today about our value creation capabilities. We talk a lot about scale. However, our effective approach of taking that scale and leveraging it to drive value within our businesses is really what sets us apart. Our market-leading footprint of differentiated capabilities enables us to deliver value creation around the globe. Our approach is simple, it's effective, but it's incredibly difficult to replicate. It comes from many years as an owner-operator, taking those lessons learned, bringing them up to the global team, and then replicating those good ideas and best practices around the world. Our procurement capabilities leave us as a multi-billion-dollar buyer of large equipment, allowing us to use our economies of scale, not just on price, but on terms and other things as well. Our commercial relationships with the largest power buyers in the world make us a large market participant in negotiating PPAs. Our financing strategy. In this capital-intensive industry, we take financing strategies that we've applied in one business, and we're able to replicate those around the globe. We have operating and development best practices that are second to none, taking them from one business up and around the world to another. Our scale and breadth of technical capabilities. We have a technical team of engineers who, during the M&A process, see the asset through to due diligence, provide support when needed during operations, and then support our M&A team upon divestiture as well in maximizing that value. And then last but not least is the Brookfield ecosystem. Leveraging the Brookfield ecosystem allows us to gain insight into deals and into directions that we would not be able to without that knowledge. And then we tie that back to these businesses using a regional asset management structure. Our asset management leaders are in the businesses, in the local regional groups. They know their businesses, and they know what value creation levers to pull to deliver the best results. They also know what capabilities are available in our global team that they can pull down to the local businesses to maximize that value. I wanted to share for a moment one of the biggest conversations I have with portfolio company CEOs a couple of months after we close. The conversation usually goes something like this. The Brookfield deal team sold a big game about value creation, and I was reticent to believe that you were really going to be able to deliver, on the results that you were promising during the deal process. But what's interesting is what comes next, because every single time that feedback from CEOs is different. And I think that's what truly shows our value creation capabilities. Whether it's scale procurement, resolving an issue with a PPA, increasing operational capabilities, hedging. Across the board, we're able to deliver value to those businesses, not just by having these capabilities in the global team, but by having a regional asset management team who understands the capabilities and is able to curate that and pull it down to those businesses when it will drive the most value. Our global procurement strategy is repeatable, and it's a key pillar in delivering our strong risk-adjusted returns. Through equipment optimization, we've taken $60 million of equipment and reallocated it in the last year alone, freeing up capital in one business and enabling development pipeline to materialize in others. I think we can all agree that it's been a turbulent few years in supply chain and trade policy, from tariffs to delays, shipping issues, more tariffs. And many of these businesses, while they're able to navigate some of these issues on their own, our scale and our reach, looking at what's happening in one region and identifying that as a headwind in another, is something they would not be able to do on their own. Strategic supply contracts are one of the key pillars to our procurement approach, leveraging our scale to negotiate large commercial agreements with vendors, and then delivering those to our portfolio company businesses on a curated approach and helping them save money on their contracting time. In development, time is money. We need to deliver on time. And these key strategic procurement contracts and the strong supplier relationships that we manage at the global level really provide us huge aftermarket benefits and a preferred status with many of our vendors. Most interestingly, I think, in the last year is the curated customer relationships, meeting the needs of the largest corporates on a global basis and tailoring our growth strategy and our development pipeline to their needs. 8 out of the 10 largest global buyers of clean power are Brookfield Renewable customers. Connor talked a little bit earlier about our Microsoft deal, and what set us apart during that deal is what continues to allow us to deliver to these other PPA corporate holders as well. Bruce mentioned a little while ago that when we compare 10 years ago, let's say, to today, and we look at PPA off-takers, 85% of the PPA off-takers we signed contracts with in the last year were corporates and not governments. We signed 12 terawatt hours of PPAs in the past year. And when we think about how we deliver those high-quality results to customers focused on decarbonization, and then we take that scale demand and visibility on growth, and we deliver that back down to our businesses to give them additional growth avenues. X-Elio, who we acquired in 2019, and we stepped up our investment in 2023. Their development pipeline has grown 4-fold under the Brookfield banner, and they've tripled their annual commissioning rate. Standard Solar, a $1 billion acquisition in 2022. Not only have we doubled their development pipeline and grown their commissioning rate 25% in the 2 years in which we've owned them, but we also took a novel financing strategy that was first of its kind when we rolled it out at Luminace, another similar business in the US of ours, and we replicated that approach quickly with Standard Solar to give them additional access to capital for their growth. And then Avada, a $400 million investment in India that we made just last year. Their development pipeline grew from 7 to 13 gigawatts in the past year, and they've put 600 megawatts of clean, renewable assets into the ground in that same period of time. So we're constantly taking these best practices that we get from around the world and implementing them into other regions. For example, we'll see a headwind in one market, that will be a leading indicator in another. We're able to use that information. So much like I talked about the Standard Solar example in financing, in high voltage equipment, that has become the largest constraint to timely delivery of renewable projects around the world. And when we saw that trend building in the US, we anticipated that that was going to grow around the world and managed to get ahead of those high voltage lead time jumps. Shepherds Flat that Connor mentioned a moment ago. At the time we did the wind repower at Shepherds Flat, that was one of the world's largest wind repowers. More than 300 wind turbines across 50 acres. This is a massive construction project. And in the next few years, there are more than 200 gigawatts of wind repowers that are going to be needed as we have a number of large renewable assets coming offline. Additionally, in First Hydro, we took our 100-plus year history as an owner-operator, and we used that to underwrite the First Hydro investment and then to also support the team upon our recent divestiture. We wanted to take a moment to highlight our Deriva acquisition last year, specifically because of the nature of the carve-out required. Deriva came from Duke Energy Renewables and was incredibly integrated with that business. Most of the back office functions and some of the front office ones were provided by the Duke parent. And while executing on these first-year deliverables, we completed the carve-out in 6 months, far ahead of schedule. It's near complete at this point in time. But at the same time as doing that and building up an entire standalone business, we have closed a number of large procurement contracts at or below underwriting. We've optimized the capital structure, completing over $400 million of financing year to date, which we expect to grow to $1 billion by the end of the year. And we commissioned 650 megawatts of new capacity. In closing, what we do when we buy these businesses is we execute on the largest value creation levers that are identified by our regional teams. We unlock those by delivering them quickly and at scale, and we enable that value creation across a number of work streams. And with that, I'll pass to Ignacio.
Hello, everyone. My name is Ignacio Pazares. I look after our renewables and transition business in Europe. And today I'm going to speak about our growth strategy, which we believe is one of our strongest competitive advantages and one that we've been building over time as investors in the decarbonization space. Connor and Hannah have been very clear about the huge opportunity that is ahead of us, so I'll try not to be repetitive. But what I will say is that to be able to capture a big portion of that opportunity, you need to be very well equipped. And the good news is that our business today is in a really strong position from that perspective. As you know, we've grown BEP into one of the largest renewable power businesses globally over the last decades. And in parallel to that journey, we have also developed a strong set of skills and capabilities around development, operations, and M&A that today differentiate our business. So starting with operations, today we operate 34 gigawatt of renewable power assets with over 5,000 operating employees, including some of the largest and the most strategic renewable power assets globally. On development, we're also experienced builders. We've been doing development forever, but over the last years, we have ramped up our development activities with our pipeline reaching 200 gigawatts. 2024 is also going to be another record year with 7 gigawatts of new capacity coming online. And then lastly, on acquisitions, the way we see M&A is as a tool to supplement both operations and development by bringing new assets to operate and new projects to develop and build. On this space, we've also been increasingly active in the recent years to take advantage to the market opportunity we're seeing, our access to capital, and our expertise. And the result of all of this has been over 30 billion of equity deployed into different acquisitions since 2020. For the rest of this section, we will focus on development and M&A as the two main avenues we have to grow both organically and inorganically. I will start with development. And I'll try to be brief here as Hannah covered most of it. But to summarize all what we have been saying around this topic, we believe that there are 4 key elements to the pipeline position that we own today. The first one is the scale of our pipeline. As I just said, our pipeline has reached 200 gigawatts, and this is key to become a relevant supplier of clean energy in the market to meet the growing demand that we've talked about. Second one, diversification. Our pipeline is very well diversified across all of our different markets where we operate and across the lowest cost technologies. Third is the status. 65 gigawatts out of those 200 are in an advanced stage and will become operational over the next 6 years. And finally, location is also very important. Our pipeline is strategically located in the regions where the largest buyers of clean power are looking to secure capacity. And this has been key for partnerships like the Microsoft one. Now, moving to M&A, the first thing to highlight is our global network of over 150 investment professionals. All of these are local people with on-the-ground presence across all of the different power markets where we operate in. And most of them have been with us for a number of years and are very familiar with our value investing approach and our strong focus on downside protection. So the combination of having a global business with on-the-ground presence, capital at scale, and the flexibility to structure different transactions is what prevents us from missing any relevant opportunities in the market. But more importantly, it positions us as the first partner of choice for many counterparts when there's a large capital requirement, and this is how we can access all of the different bilateral deals we have been executing over the past years. All of these sounds very obvious, but building this ecosystem takes time, resources, and a lot of effort, and it's not something that is easy to replicate. And this is why, at the beginning, we said that we believe this is a true and durable competitive advantage that will continue to be key for the success of our business going forward. We just spoke about our M&A network, but the scale of our capital is at least as important. We've always said that this is one of the keys to the success of our growth strategy, so I believe it's important to spend a minute explaining what this means. As you know, some of the strongest returns we've achieved come from our largest investments, where one, we have been able to acquire market-leading platforms, and two, we've done it with limited competition. And the reason for this dynamic is pretty simple. Not everyone in the market can write multi-billion-dollar checks in a timely manner with very limited financing conditionality. And the way BEP can access these large deals is by a structure where it invests alongside Brookfield's private funds. As you know, BEP only contributes around 20% of the equity in any new investment that we make. But on top of being able to access to larger transactions through this structure, BEP gets two additional benefits. One is greater diversification, as it invests across a larger number of transactions with the same amount of capital. And second, it's greater expertise by owning a larger number of leading platforms that can share knowledge and best practices between each other. The best example or way to illustrate this is our recent acquisition of Neoen. And for context, this has been the largest investment our renewables group has done to date, with $10 billion of enterprise value. And when it comes to the business, there are really 5 things we liked about it. The first one is Neoen's leadership position in 3 core high-value renewable markets like France, the Nordics, and Australia, where BEP had limited exposure prior to Neoen. Second, the fact that the business comes with a portfolio of 8 gigawatts of existing assets that provide significant downside protection to our investment. Next, it's the quality of their advanced development pipeline with 20 gigawatts of projects that already have land and interconnection secured, which is something very unique. Continuing with the team, not only we have been able to prove that they're very aligned with our culture and with our investment approach, but they have a very strong track record of consistently hitting and exceeding their targets. And as part of this transaction, they will be investing a significant amount of their wealth alongside us, which gives us additional comfort on their commitment. And then last but not least is the leadership position Neoen has on battery storage. They own one of the largest portfolios of batteries globally with almost 2 gigawatts of capacity, and they have been first movers in a technology that we believe is at an inflection point. And the reason why I say that is twofold. First, battery costs have come down by 20 to 30% over the last year, while at the same time the demand for storage products has continued to increase as more and more renewables penetrate the different power grids. And then second, we're also starting to see an opportunity in the market to de-risk the new build of batteries by signing capacity or tolling agreements that provide significant cash flow visibility for the future. This is something that was not available 1 or 2 years ago, and we believe will continue to evolve. When it comes to the execution of the transaction, I think the background is also interesting. Neoen is a business that we have been following since its IPO back in 2018, and at the same time, we've been developing a strong relationship with its majority shareholder. This has allowed us not only to be well-positioned when Neoen had to consider different options given their capital-intense nature of their growth, but also be in a strong position to move fast and have an early chat with their majority shareholder. And as part of those discussions, we were able to offer him 2 things that we understand were very unique. One was a full exit with no requirement for him to stay invested. And second, it was no financing condition with Brookfield backstopping the whole transaction. We're very excited with this opportunity, and going forward, the plan is going to be simple. We're going to continue growing the business with around 2 gigawatts of new capacity coming online every year, and we actually think there's a real chance of outperforming that plan by supporting the business with economies of scale of our broader Brookfield Renewable franchise in areas like procurement, PPAs, financing, and so on. The last message in this section, which is an important one, is that not only we have been very focused on deploying capital at strong returns, but also on selling de-risked assets. And to be clear, we always underwrite our investments on a hold-to-maturity basis, as we want to be very comfortable of owning any of our assets in the long term through many different cycles. As you know, downside protection is very important to us. However, in practice, once a renewables asset has been de-risked, we know it can easily attract buyers with lower cost of capital than ours. And this gives us a lot of optionality to rotate assets that compress returns and reinvest that capital into new higher return growth to continue compounding it more efficiently. A great example of this is the sale of Saeta Yield in Spain that was announced earlier today. We acquired Saeta back in 2018, and it's a great case study of value creation through many areas of the business. We have rationalized the cost structure, we've optimized the capital structure, we have grown through highly accretive M&A bolt-on acquisitions, and we've even built an internal development function to add organic growth to the business. After implementing all of these initiatives and de-risking the business, we believe this is what has allowed us to execute a successful exit, which gives BEP 2 clear benefits that we try to replicate on all of our different investments, regardless of the asset class and regardless of the business plan. First, we de-risk the investment through our ownership. Second, once it's de-risked, we rotate it and crystallize a strong return. And third, we raise additional proceeds to continue funding more accretive growth that's available to us today, like, for instance, Neoen. I hope that with that it was helpful to understand our growth strategy, and I'll pass it to Wyatt to discuss our financial position. Thank you.
Thank you, Ignacio. Good afternoon, everyone. For those of you who don't know me, my name is Wyatt Hartley, and I'm the Chief Financial Officer of the Renewable Group here at Brookfield. And today I have 2 very simple messages that I want you to take away. First, our balance sheet is as strong as ever, and we have what we believe is one of the most sustainable funding models in our sector. And second, we are as confident as ever that we will achieve our target FFO per unit growth over the next 5 years and beyond. Starting with the strength of our balance sheet, underpinning all of this is our strong BBB positive investment grade rating, which is one of the strongest ratings in the sector. In addition, the vast majority of our borrowings are project level, non-recourse, long duration debt, which translates well on a maturity basis with an average remaining term of over 12 years and no material near-term maturities. And as Connor mentioned, our liquidity is as strong as ever with $4.4 billion available, providing significant financial flexibility to take advantages of the opportunities, the growth opportunities Connor and Ignacio highlighted. Also, as I mentioned, we have a sustainable funding model with access to flexible and diverse sources of capital to fund our growth. When we finance our business, our focus is to prudently source our lowest cost of capital. What this means is we maximize corporate debt, preferred equity, and unutilized debt capacity at our existing assets, but all while maintaining our strong investment grade ratings. It also means capital recycling will continue to be an important part of our funding strategy where demand for our assets, as Connor and Ignacio mentioned, remains robust. As I highlighted, we have significant unutilized debt capacity across our assets, primarily our hydros, whereas we continue to lock in long-term contracts and benefit from the incremental cash flows that generates. We are also meaningfully increasing their financing capacity. As Connor discussed, an example was where we recently signed power purchase agreements at 2 hydro facilities with utility offtakes. Both contracts represent an attractive premium to current prices, which translates to meaningful additional FFO. But as importantly, given the duration of the contracts and the quality of the counterparties, we are in process of raising an additional $500 million of non-recourse investment-grade debt at very attractive rates. And we redeploy this capital into growth at our target returns, which generates significant additional FFO for the business. And given the remaining hydro capacity we have available for recontracting across our fleet over the next 5 years, we expect this to be a material funding lever for our business going forward. And we are ramping up our capital recycling activities while continuing to generate excellent value. As both Connor and Ignacio highlighted, capital recycling is not only a valuable part of our funding strategy, but it is also a critical way that we create value through a full-cycle investment strategy. Furthermore, when we redeploy these proceeds into higher-yielding opportunities, it translates into additional FFO. For example, with the proceeds we have generated over the past 4 years from these activities, we have created over $100 million of annual FFO by selling assets at an average FFO yield of 8% and reinvesting those proceeds at an average FFO yield of 15%. And as you can see, with this significant ramp up in these activities, we expect our FFO to benefit meaningfully from our asset rotation program going forward. Moving next to the quality of our cash flows, simply put, we believe we generate the highest quality cash flows in the sector. This comes from our largely perpetual and dispatchable asset base, our highly contracted profile that has an average duration of 13 years, with 70% of our contracts indexed to inflation. And finally, as we have grown our business, we have also significantly de-risked our cash flows by increasing the diversity of our portfolio. Our current business is diversified across multiple markets and technologies, such that no single market represents more than 10% of our business. And the tailwinds we are seeing across all of our growth levers continue to strengthen, meaning as I stand here today, our outlook to achieve FFO per unit growth in excess of 10% over the next 5 years is increasingly secure. Further, as we look out over the next decade, we have increasing visibility that we've secured each of the building blocks driving our growth. The first is inflation, which, given, as I said previously, 70% of our contracts are indexed to inflation, with significant operating margins, our cash flows benefit in an inflationary environment. And with an average contract duration of 13 years, we are positioned to benefit from FFO growth over the long term. And on the back of growing electricity demand, led by the power needs from data centers and AI, the demand for base load or dispatchable carbon-free generation provided by our hydros continues to strengthen. As an example, this year alone, we have secured contracts that will generate almost $50 million of additional annual FFO for our business. And looking forward over the next 5 years, we have 6,000 gigawatt hours per year of generation that is rolling off contracts. And given the increasingly constructive all-in pricing environment I mentioned, which includes the grid stabilizing features and renewable energy credits that we sell from our dispatchable hydro assets, we are seeing almost $100 million of additional potential upside to annual FFO. And as we look out over the next decade, we have an additional almost 5,000 gigawatt hours per year of generation that is well positioned to benefit as well. And as you have heard throughout our presentation today, we continue to ramp up our development activities. As I discussed last year, we take a de-risked approach to development that generates attractive risk-adjusted returns while delivering projects on time and on budget. And with our 65,000 megawatt advanced stage pipeline, which means we have effectively secured site control, permitting, and grid interconnection positions, our development activities have increased. And we expect to achieve an annual run rate of 10,000 megawatts of projects commissioned within the next 3 years, which translates to $350 million of annual net FFO by 2029. And with agreements like our partnership with Microsoft, we have increasing visibility on our ability to deliver at least at this level over the long term. And finally, as both Connor and Ignacio touched on, we are deploying capital into M&A at record levels into highly accretive transactions. So bringing this all together, with the additional tailwinds in our business and our highly sustainable funding model, we are highly confident that all roads lead to growth at our most historic rate over the next 5 years and beyond. So with that, I'll turn it back to Connor for key takeaways.
So I think we've run a little bit over, so we'll keep this quick. Today, we have a larger market growth opportunity than at any point in our history, and we feel that we have both the business model and the strategy to capitalize on that growth. And as a result, we are more confident than ever that we should not only meet, but exceed our financial growth targets over the next 5 and 10 years. And given where we're at with time, I'll suggest that we only take one question, but the team is around and will be available to answer any questions after the final presentation. Any Q&A from the audience? Sure.
Hey, Connor. Everyone's been talking about AI data center demand, so I thought I'd stick with that theme. So obviously, I think we've heard about how demand is outstripping supply, and I think we're also hearing that data center demand, they just want power from any source, including fossil fuels. So from Brookfield's perspective, like obviously you're focused on renewable energy and you're obviously involved in nuclear as well. But if renewables is not the solution for them, is there a role for Brookfield to play going forward?
So we'd come at this from 2 different directions. You're absolutely correct. The power demands required by the tech sector are immense, and they are looking to secure as much power as they possibly can. But in looking to source as much power as they can, they will first fill their boots with as much renewables as is available. and that's because it's the cheapest. That dynamic is not driven by decarbonization trends. They will take as much as the cheapest source of power before turning to other alternatives. And therefore, are we going to see growth in other forms of power generation in the coming years, particularly in data center heavy markets like the United States? The answer is absolutely yes, but turning to alternatives to renewables will only be done after the renewable opportunity is completely exhausted, because it is the cheapest and the cleanest alternatives. We do think this will be a major driver of nuclear over the next 5 to 10 years, and we're thrilled to have exposure to that growth. And we do think this will drive increased use of gas generation in the United States for at least the next 5 to 10 years as well. With that, thank you, everyone, and we will hand it over to infrastructure.